Okay, well, let's go ahead and get started. Welcome to the Preferred CFO monthly web class. My name is Scott Crawford. I'm a partner here at Preferred CFO. Tara Chrisman will be the admin for today's meeting, so you may see her as well. I'd also like to introduce Jerry Vance. Jerry Vance is my friend, and from 30 plus years, he's our founder and managing partner, and he is here as a panelist should there be some additional questions that we can direct towards him. But Hunter Vance is our presenter today. His topic is best practices for managing cash flow, how to keep your business afloat in times of drought, and oxygenated in times of opportunity. So we intend to be about 45 to 60 minutes. A little bit of that timing depends upon the Q&A. So Hunter has asked that we have questions and answers timely to the topic. So rather than hold everything to the end, we'd like to address questions and answers as they come up throughout the presentation. So if you would please use the Q&A button at the bottom of your screen to ask questions. And Tara primarily, but I also will monitor those and will feed those to Hunter as he finishes the topic and is asking about Q&A. And then when we come to the end, if there's other questions, we'll either use the Q&A button or we can use the hand raise button. If you have specific questions about how this applies to you and you don't want to get into the detail to the confidentiality, more than happy to spend some time with you or have another member of our team give you some pro bono time and apply the topics to your company or the specific reason that brought you to this web class today. There is no cost for these web classes. They're offered as part of Preferred CFOs Association with Vistage. And before I turn the time over to Hunter, our upcoming meeting, our next one will be the last Monday of October, the 28th, and that is Managing Human Capital, Key Considerations with Recruiting, Retention, and HR Legal Compliance. And then our November topic will be one of my favorite, the secret sauce, improving profitability. How to improve the profitability of your business by drilling down on products and customers. So with that introduction, let me turn the time over to Hunter Vance. And again, please use the Q&A button at the bottom to submit any questions you have as we go along, as they come to mind. And Hunter would like to address those before we move on to a next topic. So Hunter, the floor is yours.
Perfect. All right. Scott, are you able to see my screen there?
I can. If anybody cannot, please raise your hand or drop a question in the Q&A if you cannot see the screen.
Okay, perfect. All right. Well, thanks, Scott. I appreciate the introduction. I appreciate you guys joining our webinar today. Like Scott mentioned, we'll be talking a little bit about cash flow. The title of the presentation is here, Best Practices for Managing Cash Flow, How to Keep Your Business Afloat in Times of Drought and Oxygenated in Times of Opportunity. All right. So just to kind of kick things off, I just want to, at a high level, discuss a few of the things that we're going to touch on. First thing is just the importance of having a cash plan, the difference between being a profitable company and being a cash flow positive company, preparing for a cash shortage, managing customers to be able to manage your cash properly, some additional cash strategies, and then kind of the most important and most applicable topic is just going to be how do we actually put some of these things into practice? How do we project some of this? How do we use it in a model to see what our cash needs are going to be, 6, 7, 13 weeks, months out into the future. I'll show you a couple of different templates we have. We have one that's that we use with all our clients here at Preferred CFO. It's a proprietary model. It pulls in actuals from in the model I'm going to show you, it pulls it in from QuickBooks and just kind of makes it easy to be able to forecast cash. But in addition, I've created a more simple model that you can manually put in cash balances and forecast cash out by customer and vendor that at the end of this, if you're interested, I'd be happy to send your way so that you can use it to forecast things out in your own company. And then at the end, obviously, we'll have some Q&A. Like Scott mentioned, I really want to make this so that it's applicable to you and your company. So as you have questions, type them in the Q&A, and I'll circle back and answer them as the topics are fresh, and then for any lingering ones, we'll have a Q&A at the end. Okay, so the first thing to talk about is obviously the importance of cash. Cash is king. We hear that all the time. It's a common saying in the business world, but surprisingly few business owners take the necessary steps to properly manage their cash flow. Making cash flow a priority will prevent a business from winding up with an empty bank account and nothing with which to pay the bills. Just like having a healthy lifestyle and regular physical checkups can prevent and detect health problems. Paying close attention to your cash flow can help keep your business free of financial problems. But kind of as mentioned here, cash is obviously very important. We all know that, but many times businesses kind of forget about cash until it becomes a problem. And so it's really important that we're consistently and constantly monitoring our cash to make sure that we're not going to have any serious problems down the road. Just like you go get regular checkups from the doctor to make sure your health is fine, you want to do the same thing with cash to prevent problems rather than treating them when it's already too late. So an important thing to understand is the difference between being a profitable business and having positive cash flow. And cash flow is the cash that flows in and out of your business. Profit is whatever remains from your revenue after costs are deducted, all payables are paid, and all receivables are collected. Profit will show the success of your business after cash has changed hands, but cash flow is what keeps the business alive. Many failed businesses might have been a profitable business eventually, but they didn't have the cash flow to get to that point. While profit is the goal, cash flow is the lifeblood of an organization. For growing businesses, cash flow is probably the number one concern. Profits can't be the only thing that are monitored. Cash flow needs to be constantly watched as well. It's common for a business to be profitable but have poor cash flow. For example, a small electronics manufacturer selling wholesale products to large companies that receives delayed payments could mean they're unable to pay their suppliers. Even if the company has successful products with rising sales, it could end up facing cash flow issues and be unable to meet its financial obligations. So that last bullet there touches on a company that may be profitable. So this electronics manufacturer, they may have high margins. They may be a very profitable business. If you look at their P&L, you're going to see that they have positive net income. They have high margins. But if they're having to put a lot of cash up front in order to purchase and manufacture these electronics, and the receivables don't come in as quickly as they might hope, they might end up going cash negative before they're able to really realize those profits. And so it's important to not only look at your P&L, which obviously you want to be profitable, but also you have to understand the timing between the purchasing of, in this case, the products, and the timing of the receivables, and make sure that there's enough cash to realize those profits at the end. All right, so a couple of items to help prepare for a cash shortage. Number one, it's always a good idea to keep a cash reserve for unforeseen expenses and emergencies. So the amount may differ depending on industry, but 3 months worth of expenses is usually good practice. So again, it may be different with your company. Maybe you only need 1 month, maybe you need 6 months worth of expenses in the bank, but 3 months is a really good place to start. So again, I would kind of look at it at your company in specific and try to determine what a good safety valve is going to be for having cash in the bank. A lot of times, and I've seen this with a number of companies that I work with, they see that their profitability is really good and business is going well, and so they make distributions and don't really realize that because they're growing, or for whatever reason, they end up facing cash shortages and didn't have 3 months worth of expenses or more in the bank because they're doing distributions, things like that. So it's always good to just make sure before doing a distribution or things like that, that cash is going to be all right for at least 3 months or whatever your company decides. Another item to help prepare for a cash shortage is to have a line of credit in place, particularly if your industry is impacted by seasonality. Obviously, you don't have to use that line of credit until you need it, but it's always a good idea to have those relationships with the banks already put into place and have a line of credit so that if you do come into a situation where you have cash issues, you're not scrambling and you don't have to take not as beneficial rates and be in a tough situation. So it's a good idea to have a line of credit established for if you need it. That way you can draw on it when the need arises. So another thing, if a loan is not an option, you can always consider a business credit card for any short-term expenses. Obviously, rates are going to be higher with credit cards, but in the case that you're not able to get a loan, it may be your only option, and so that's another thing to consider. And then just the last thing I have here is put safety procedures in place before cash becomes a problem to fall back on if needed. It's a good idea to have those conversations about if we do have cash issues, where are we going to cut back? Where are we going to pivot to? What are we going to do? That way, if it is something that takes a little bit of time to realize that you've already done a lot of that preparation and planning, so that if there is a cash situation, you'll be able to pivot accordingly. All right. Let's see. The next thing to cover here is the management of customers in terms of cash. A really obvious one is to collect receivables, identify customers who consistently pay late, set up a collection schedule so that those payments don't fall through the cracks, keep up with accounts receivable, and this will mitigate the chances of a cash crunch. So in my experience, and I'm sure a lot of you have had the same experience, but there's a lot of customers that they may not necessarily pay until you kind of reach out to them and start getting that ball rolling. And it's a good idea to identify those ones that always need a reminder and remind them sooner rather than later. So obviously that time to get paid can will be a lot shorter. So if you stay on top of it, it'll be a lot easier to manage your accounts receivable and make sure it doesn't get out of hand. Another thing to do with customers is to make payments easy for them. Try to avoid being paid via check, as it will result in delays. Give your customers as many options to pay as possible, like credit card, debit card, electronic payments. There's lots of different platforms to be paid electronically. It typically makes it a lot easier for the customer. It makes it a lot easier for you. You don't have to wait 30 days for a check to be mailed, and you're able to get that cash into your bank account a lot quicker, a lot sooner. So I'd highly recommend doing everything you can to make it as easy to get paid as possible, and have it be in a timely manner as well. Another thing to consider is the invoicing frequency. Delayed invoicing only leads to longer delays in cash receipts. So consider invoicing more frequently to expedite payments. Example of this would be invoicing weekly as opposed to monthly. There may be some cases where, let's say that you bill at the end of every month for that month's worth of work. If you're in a cash situation, you may consider billing at the end of each week. That way you can get a little bit more cash flow coming in. You don't have to float an entire month's worth of work. Instead, you would just do 1 week at a time. You get paid a lot quicker. It's obviously something to consider. It may be more work in terms of the accounting and taking care of receivables and things like that. But in a cash shortage, it may be worth it to switch the billing up to be weekly as opposed to monthly. And then the last thing I have here is to end unprofitable relationships. We all know customers that never pay or that are unprofitable. In a cash shortage, it may be a good idea to kind of remove them and focus on clients that contribute to the bottom line and not detract from it. That will help keep your cash positive as opposed to turning it negative. Okay. All right, a couple of other strategies that I have here is to manage your inventory properly. This is one that may be obvious to some and a new concept to others, but having too much inventory on hand will tie up cash. Obviously, you need enough inventory to fulfill customer orders, but it's important to maintain a healthy balance between having too much inventory and too little inventory. If your levels are too high, you may consider discounting your prices to liquidate your inventory so that you can generate cash and get back to a more sustainable level. But obviously, it's a tightrope that you have to walk. If you have too much inventory, a lot of your cash is tied up in inventory. If you don't have enough, then you may be missing a lot of sales that come through. You're unable to fulfill those orders, and that equally could hurt your cash situation as well. Scott, I know, has a really good example of a company that unknowingly loaded up too much on inventory. It hurt them cash wise, and they had to pivot. They had to liquidate their inventory. Scott, maybe you can pop in and just kind of tell your experience with that.
Yeah, I'll make it very brief. Those who have sat in on a seminar that either I have conducted or that Bob McDonald has conducted for different Vistage groups will have had a chance to be able to work through the financials of this particular company. Obviously sanitized, but no, I wish it were a unique situation, but this was a very poignant situation where the CEO was working with gut instinct and coming out of COVID foresaw supply chain problems coming and felt like the best move that he could make would be to bring in a bunch of inventory from China on overseas where it was produced. And he did that before freight rates went up and before the cost of the product went up, and he secured pricing into the future at the more favorable rates that were available at pricing coming out of COVID. But he did so without any forethought or planning into the future. And he found himself, fortunately, with a good CFO that came in at the last minute after he had made all these other decisions and they had been acted upon. But the CFO was able to give him some vision 5 months down the road to keep him from going out of business. Otherwise, he would have been inventory rich and cash poor. And to his mind, it would have been the end of his business rather than being a successful move made on the part of the CEO. So the message there is you've got to make good informed decisions and realize that every decision, almost every decision, has an impact upon your cash requirements.
Thank you, Scott. So, yeah, just following up on that, when you're managing your inventory, it's a good idea, especially if you're in a cash crunch, to rather than just stock up, like Scott was saying, happened with that company. Model that into your cash projections, see what that looks like, make sure that you can afford to tie up cash and inventory. And if you can't, you model out what's going to make sense in terms of your cash balance. But it's important to make an informed decision on how you're managing your inventory and how it relates to cash rather than just a gut instinct like Scott was touching on. The other thing I have here is to grow carefully. Growing your business too quickly can be highly risky. As you ramp up to sell more, you first need to spend more by buying more raw materials or hiring more staff. The amount of time between your increased expenses and increased sales collections is too long. You could find your business starving for cash. Have a business growth plan in place that avoids long delays between cash outflows and inflows, and that pays very close attention to managing cash flow levels. So this is another one where it may seem like if you grow quickly, all your problems are solved. If you can sell more, all your problems are solved. Well, that may be the case in a lot of situations. It's important to understand what type of additional expenses are going to be associated with that growth, the timing of being able to collect, and kind of that gap between the expenses and the collections. Important to model out any growth in your cash projections. Make sure that you're not going to grow yourself out of a business and put yourself into the ground. So this is probably a good time. I haven't seen, let's see, are there any questions that have come through? If there's any questions on anything we've covered to this point, just drop them in the chat in the Q&A. The next thing, this is kind of more of the conceptual cash strategies, the next thing that I want to move on to is kind of where the rubber actually meets the road, the actual modeling. I'll show a couple of templates. So if there's any questions on any of the conceptual cash strategies, feel free to ask any questions in the chat. If not, we can just move on to the next portion. But I'll give
Hey,
you guys just
Hunter, got a couple of questions. I'm going to pass them along, even though I think to many people they'll seem obvious. But when do most companies run into a cash crunch?
It's usually because they're not paying attention. An obvious one is obviously if sales are declining, you're going to run into a cash crunch. But also on the flip side, and I just kind of touched on it, you may run into a cash crunch as well if sales take off too quickly, or you're growing too quickly, or investing without kind of understanding where you're going and trying to grow the business too quickly. But in my experience, it's typically when sales are declining or receivables are they're getting too large, and to be able to pay the bills and keep the cash positive.
Yeah, Hunter, I heard the term the other day that I don't think I'd heard before of grow broke.
What's that you broke up on me?
Grow, it was GROW, grow broke. In other words, you grow so successfully, you go out of business because you're not seeing the need, the cash need that growth is going to require.
Yep.
I do recall, Hunter, very briefly that earlier this year, I was asked by a Vistage group in one part of the country to come do a citywide event for all the Vistage members there. And I asked them specifically, what are you struggling with? And they said the economy here is really strong, and most of our members are growing dramatically, and they've all got cash flow problems. And I remember I huddled with you and a few other members of our CFO team. I said, what is the right answer to this? Because I think I know, but I want to involve as much brain power as I can. And your answer was pretty simple: forecast. Because it's cheaper to get a loan, it's cheaper to get credit before you're in a crisis mode, if you can even get it all then. And it's just a matter of being able to see further and further down the road to anticipate the cash needs caused by growth or today's decisions.
Yeah, and I like the answer you say there's forecasting, whether you're in a difficult cash situation or you're doing really well and you're planning on growing. It's pivotal that you forecast what your cash is going to look like, to make sure that you don't have any problems down the road. Now, the method of forecasting may be different depending on how tight cash is. If you're expecting a cash shortage, you'll likely forecast by customer, by vendor, be very granular. You may do it as often as weekly or daily, just depending on how tight cash is. Whereas if you're planning on growing, you would likely forecast cash using your 5-year forecast, using changes in balance sheet accounts. I don't want to get super into that, but it would be a more general forecast of cash to make sure that you still have the necessary capital to grow. It would be less based on vendor and customer. But either way, whether it's you're planning on growing the business or the business is struggling, you need to have a cash forecast in place. Like you said, Scott, it's a lot cheaper to just forecast, and you save yourself a lot of headache if you're just continually on top of it and making sure that you're not going to have any issues.
Yeah. Well, Hunter, I can see your next topic is the 13-week cash projection. And I know in talking to a bunch of our clients and also contacts that with increasing frequency, they're having key customers call them up and say, I'm going to be delaying a payment to you. I'm assuming that what you're going to talk about next would give a company some ability to respond to that or know how to respond.
Yep. Yeah, exactly. Scott, if you'll bring that question up when I pull up some of the model examples, I'll make sure to address it then and kind of show you visually how you would be able to respond to that, and react to it.
Perfect. Thank you.
Okay, so moving on to the 13-week cash flow projection, really where you actually start doing some of the work to see what your cash is going to look like. This is something that either your CFO or your controller should be managing kind of depending on the severity of the situation, depending on the skill set of the individual, but typically your CFO or your controller is going to be managing the cash projections and deciding when cash should go in and when cash will come in and when we would expect cash to go out. So what it is, it's a 13-week or 3-month minimum projection of cash. This, and I touched on this a little bit, but you want to use this 13-week cash flow projection if cash is tight. So if cash is in a situation where you may potentially be heading into a difficult spot, you're going to want to use this 13-week cash projection. If you're in a position where you have a ton of cash in the bank, you know you're not going to go cash negative within the next 3 months. You still want to project your cash, but you're going to want to do that in your 5-year forecast. So this is more on if cash is going to be an issue, you want to do it for 13 weeks or 3 months as a projection of cash. Kind of touched on this earlier, but your projections should be granular by customer and by vendor. You're going to want to have lines for each customer, each vendor, when you expect to receive cash in from each customer, when you're going to pay your bills by each vendor, and then a summation of all of that to show what your total cash in and cash out is. It gauges the company's short-term financial health and future cash flows. It's a daily cash operational tool. Historical cash flow should be included to aid in predicting short-term future cash movements and adjusting the cash strategy accordingly. So what that means is ideally you want to show the historical cash outflows by customer, by vendor, by GL account, because that's going to give you an idea of what your projected cash inflows and cash outflows are going to be. So for example, if you have a subscription, say that you have a $10,000 subscription to Adobe and it's a yearly subscription. Well, if you have the historicals in, you're going to see that every August or whatever it is, you have this $10,000 payment that you're going to make to Adobe. There may be a ton of other subscriptions as well, but it can be easy to forget that you have that $10,000 automatic renewal each year if you don't have some of those historicals to remind you and kind of show the pattern of typical expenses by vendor or by customer. You may have a customer that pays you once every other month. If you're able to see some of this historicals, it's going to help you project a lot better than if you just try to do it solely based on memory or really just kind of using your best guess. Obviously, it won't be perfect, but it's very helpful to have the historicals pulling in and making sure it transitions properly into forecasted periods. Why it matters: sinkhole avoidance. It helps you identify potential liquidity shortfalls and short-term financing needs before they happen. It's a payment roadmap. It documents to the accounting staff which bills should be paid and when. Reveals how different cash decisions will impact ability to meet obligations. So I really like that one, that it's a payment roadmap. It very clearly and easily signifies to whoever's actually making the payments when things should be paid and when they shouldn't. If in your cash projections you say we're going to pay this vendor in 3 weeks, it's really easy for the bookkeeper or controller, whoever it is that's making the payments, when they get an email from the vendor that, hey, when's this going to be paid, you can refer to your cash projections that the team is all in alignment on, that makes sense with the plan, and you can easily respond and make sure that things are being paid when they should be. You don't want them to be paid too late. You don't want them to be paid too early. So it helps keep the whole team on the same page of when things should be paid. And then finally, it's good for emergency preparedness, helps in uncovering and navigating unexpected cash shortage events or emergencies. So this may be, let's see, it may be a little small, but I'm going to pull up this actual model. I just wanted to put this on the slide just to point out a couple of elements. Let me see if I can see. Yeah, little laser pointer here. So in your 13-week cash projection, and again, you may do it monthly, however you'd like to do it. there's a couple of key elements you're going to want to have. You're going to want a summary of your cash in and cash out. So you'll see here, these are actuals. So these are prior months. Well, this one's done weekly, so these are prior weeks. Actuals going back a few weeks, you can show more actuals, but it's going to show you what your beginning cash was, how much cash in you got, how much cash out, and then your net cash in, cash out, and your ending cash. So, you have your historicals here, and then you have your forecasted cash. So your forecasted cash in, forecasted cash out, whether that's going to be a cash positive or negative period, and then your ending cash balance. So this line here is the one that you would pay a lot of attention to as you're making decisions based on cash balances. As you can see here, this company was having some pretty serious cash difficulties, and that's the reason why this forecast was built out weekly, is because we had to be very deliberate, very specific about what things to pay and when. And so with this company, we met weekly to decide which bills we were going to pay, and then you can see that finally they got some cash in by some investors, and they're in a much better spot cash wise. So this is kind of a summary section that you would want to have in your model, but below you want to have the detail of what makes up that cash in. So if we see here, we're forecasting $10,000 to come in the 17th of August. You can see here there's that 10,000 or 126,000 in September. Here's that 126,000. Here's what it's made up of. So that you have by customer, we can see that this customer paid 20,000 this week. They paid 500,000 this week, and we expect in this week from this customer to get 10,000. So this is just being very specific by customer, evaluating this consistently, moving the amounts back or forward as they need to be moved to make sure that this summary is updated properly. The same thing here with cash out. This is by vendor. So you can see historical vendor payments made, and then it transitions into forecasted amounts that are going to be made to those vendors as well. So I'm going to pull up, let's see. Scott, can you see my screen now with the Excel model?
Yes, I can, Hunter.
Okay, so this is just a sample of a proprietary preferred CFO model. This is what we use with all of our clients in helping them manage cash. It's a very robust and detailed model. I guess just to give you a high overview, it pulls in all of the balance sheet, pulls in all of the actuals from the accounting software. In this case, it's QuickBooks. We pull in all of the AR aging, all of the AP aging, and it all boils down to some of the screenshots that you saw earlier, which is the actual cash in and cash out. Here's the summary that I showed you earlier. Here's the details, so you can see the actual cash in. This is an actual period, and then it transitions into forecast periods. But it's a very powerful tool in being able to forecast cash. In the case of this client invoices large amounts kind of sporadically. They're not consistent cash in payments. And so with this client, it makes a lot of sense to forecast manually the amounts that are going to come in by customer and when they're going to come in. So you can see here that this customer, here's the AR aging. They had, when this was updated, they had $10,000 in AR aging that was current, and so we forecasted that to come in 4 periods, 4 weeks later. Or you can see here, this one had $100,000 that was current. We forecasted that to come in 4 weeks later as well. So this client has very few customers, a couple large customers, and so it made sense to customer by customer be manually forecasting when cash would be coming in. Now, there's a lot of circumstances where you may have a monthly reoccurring amount that comes in. Maybe it's $10,000 every month, something that is really helpful, is being able to build that in. So for example, if this was a client that we got paid $10,000, let's say it's the last week of every month, I would be able to build in $10,000 coming in the last week of every month, basically into perpetuity. So depending on the situation with the customer, their payment schedule, kind of if it's reoccurring, you can build formulas in to, to kind of facilitate some of the outgoing periods. Maybe it's a monthly amount, maybe it's a weekly amount, maybe it's a quarterly amount, whatever it is. You can pick up patterns, and this client isn't a great example, but a lot of times if you have the historicals, you'll be able to pick up patterns of when customers pay, which is obviously different than when you invoice them. You may pick up a pattern, they always pay 45 days after you send an invoice, and you can kind of build that into, you could build in the invoicing and then show that 45 days after that client is invoiced, you're going to expect to get the cash in. So there's a number of different things you can do, but you want to do it by customer as granular as possible, and then review it consistently to make sure that it's still on target with what you would expect. So you see I have cut by customer, by investor here. There's some investors that were forecasted to put some money in as well. And then you have kind of the total cash in by week. Now the same thing here for cash out. I have a number of larger vendors, and these ones have different patterns. So this one right here, because I have actuals coming in, I can see that, we pay these guys roughly $25,000 the first week of every month. So I have a formula built in. First week of every month, I'm planning on $25,000 coming out. Or this one here, I can see historically, this one got lumped up, but we pay this vendor $14,000 the first, maybe second week of every month. So I build that in going into perpetuity, and you do that for each of your vendors. There may be some that are not going to have a pattern. So like this one here, it has more sporadic payments, and so rather than build out a formula that into perpetuity, we put in manual amounts when we expect to pay that vendor. Or this one right here, you see we have some accounts payable. It's just a one-time thing, and so we put in a one-time amount when it's going to be paid. Makes it really easy for the bookkeeper to know when they should remit this check, and kind of keeps everybody on the same page. Now you'll also see here that I have some vendors broken out specifically because they're larger vendors. And then I have some things that are just rolled up into GL account. So like payroll or advertising or insurance. There's some smaller items that, rather than break them out separately, it makes more sense, and it's a lot more manageable to have them roll up into a GL account. For example, you may have 300 different vendors, and it wouldn't be feasible unless you're in an extremely tight cash crunch, and I still would probably recommend trying to consolidate them to some point. It may not make sense to have them all be forecasted out separately, and it may make sense to roll them up into a GL account. Like software dues and subscriptions is a really good example. You may have an Apple subscription at $10 every month. It may not make sense to break them out separately and review them every single month. It may make sense to consolidate a lot of those smaller subscriptions and just take an average of what those are going forward. And it depends on the situation, but that will make it more manageable and easier to be able to maintain this and not make it a huge chore every time you want to update your cash projections. So in our model here, we have basically a filter, and it's dynamic, but in this particular instance, we said we only wanted to forecast vendors that we had paid $5,000 or more over the last 24 weeks. So in the case of all of these vendors here, they've been paid $5,000 or more over the last 24 weeks. maybe cash gets a lot tighter and we say, hey, anyone we've paid over $1,000 or more in the last year, we want to break out specifically, or maybe we want it to be less granular and we want to say it's $10,000, whatever it may be. That's some of the ability that we have, and that I would recommend building into whatever cash model that you spin up. Building in that capability to find a good balance between being granular and building things out by vendor or customer, and then also making it so that it's not a huge chore to update weekly or monthly or whatever it is. So if I can come back to this, but if there's any questions or comments on kind of how this model really operates and some best practices with this model. I guess actually, Scott, the question you asked about if a customer calls and asks or tells us that they're going to be paying us at a different time, when that happens, let's say that it's this customer, we're expecting to get this $20,000 in the end of August. What we would do is figure out what the timing is. We would move it. Maybe they say they're going to pay us the 5th of October. We move it to there. And then we make sure, obviously in this case, it's pretty cash flush, but you would want to make sure that you're going to have enough cash to survive and you're not going to be getting too close to the line. But that would kind of be a simplified exercise of what you would do to make sure that you're on the same page with your customers, your vendors, and make sure that it aligns with your cash needs. Does that kind of address the question you were asking, Scott?
Yep, Hunter, and surely that reflects then your cash flow for the subsequent weeks until you are able to receive that delayed payment, and you'll be able to know if you're going to run into a shortfall and whether you've got to make some other arrangements. We did have a question come in, and it's how do you manage the 13-week cash flow statement when you have different customers from week to week? I think they self-answered. Are you pulling the customer list from the accounting software weekly?
Yeah. So with this model here, weekly we pull on the actuals. So once this one's a couple weeks old, but once the 17th of August had passed, we'd pull in the accounting again, or we pull in the transaction data again, and it would reflect any actuals that had come in. Now, if you have different customers from week to week, say that you have 1,000 different customers, there may be a couple of large customers that you say, hey, we're going to break these large customers out separately. And then there may be 800 other customers that are really small one-time customers. In a situation like that, what may make the most, and again, a lot of it depends on how tight cash is as well, but you may segment that out between a couple of different revenue lines. You may have 5 different revenue sources that make up those 800 different customers. And what you can do instead is group those customers by the revenue source and project out how much of each revenue line you're expecting to do weekly or monthly or whatever, and then build in a collection assumption. So day sales outstanding. What I would do, what I have done with a number of companies, is you pull in their historical day sales outstanding. It may be roughly 50 days, and so then you can project out anything we invoice this week. On average, it's going to take us 50 days to collect, and build that formula in so that the collections are showing up 50 days later after they're invoiced in your cash flow model. So without a ton of additional specific detail on that situation, if you have different customers consistently, or they're small customers, or there's too many to handle, you want to try to segment them out into accounts or different categories, and then you're gonna have to make some general assumptions based on your historicals, how you've done collecting in the past. And if there's a follow-up to that, I don't know if I completely understood the question, or if I got it complete, but if there's a follow-up to that, just type in again whatever the question is, and I can try to hit on it again.
Yeah, I think we've covered most of the Q&As. Hunter, is it safe to assume that, let's go to the other side of the equation. You've got a retail business or a consumer-facing business, and so you don't have any specific AR. It's whatever walks through the door and gives you their payment.
Mhm.
Is it a safe assumption that you're going to base your expected cash in on previous histories by week, and then couple that with whether you're running a promotion and your
Yep.
historical impact of that promotion upon your retail sales, and that's your cash generation?
Yep. Yeah. So there may be some seasonality that is associated with it. Maybe December is a really high month, and so the very first thing that I would do is look at what have we done historically. When are high months as a percentage of there's a number of different ways to do it, but as a percentage of revenue for the whole year, how much do we do in December? How much do we do in January? How much do we do in February? So I'd build some of that seasonality in, and then project that out based on what I think our sales are going to be for the year. And then on top of that, depending on how severe the cash situation is, you may put a buffer in that says, hey, we're only going to count on 80% of this. What we think we're going to do, we're only going to count on 80% of it. That way we're very conservative in our cash projections and we don't overstate what we expect our cash in to be.
Perfect. Hunter,
Um,
I know that at the beginning you referenced you had a template that was obviously
yes.
more easily managed than this, some more simplified that you make available. I know as we come upon the final 10 minutes, I imagine everyone will want to hear about that. And I have a request for a survey. I'll send it out in chat. But if you wouldn't mind, my question really is, in year-to-date 2024, have you experienced, number one, an early paid discount opportunity where a supplier said, hey, we'll give you a discount if you'll pay us early? I don't think it's nearly as common as it used to be. Or number two, you've had delayed accounts receivable where you've had customers that'll tell you that they're going to pay you late. So one, you get a discount if you'll pay somebody early. Two, you're just getting paid late. If you choose to participate in the survey, please use the Q&A button, and I'll send this instruction out in chat right now. Go ahead, Hunter, carry on.
Okay. So this is a template, just a really simple cash projection template that I built out. I'm happy to send it to anybody that wants it, just as kind of a getting started thing. You're gonna have to customize it to your business. It's no two businesses are the same, and the way you think about revenue and project revenue and your expenses and all that, it's all gonna be different. Um, this template here is it's a monthly cash projection. You can change it to be weekly, but this is just kind of a general idea as most basic core of what your projection should look like. It's just a simplified version of what I was showing you before. Basically, it's going to show your beginning cash here. It's going to show your total cash receipts, and it's a sum of what you build in here. Your cash disbursements. It's going to show here what your ending cash is. So as you can see in this example, I went through, I built in all the cash I think I'm going to get by vendor. I have some other cash in. It's maybe 100 different vendors or 100 different customers. I have some other cash, and then I have all my cash disbursements I expect to make. I got my payroll and a number of different vendors. And I can see here in January, I'm gonna come up short, and I'm gonna get as low as $90,000 in the hole, based on my expected cash receipts and cash disbursements. And if I'm able to put these projections together in time, I can identify when I'm going to have some cash shortages in these months, and I can draw on my line of credit. So hopefully you already have a line of credit in place. But if I were building this cash projection out and this was an actual situation, I would see, okay, by the end of December, I'm going to be pretty low on cash, about 8,000. I'm going to need probably about 90,000. I may want to draw some more on my line of credit just to be safe. Maybe I'm going to draw 150,000 on my line of credit here. You can see that this updated to show that I'm going to have $62,000 at the end of the day. And I can see here in May, obviously you have to pay this down. I'm going to be able to pay down that line of credit. I don't know what the interest would be, but let's just say that it's $10,000. see that I build in my down payment of the line of credit, and then I continue on my way with cash projections. Obviously, you'd want to build out a number more periods, but that's an example of something that you would do to react to a potential negative cash situation. Or there's a ton of different ways to react to it. You may say, okay, well, we need to do a reduction in force, and so starting in this month, we're going to move our payroll down to, we're going to have to get rid of some people. We're going to move our payroll down to 75,000. We're going to continue it on at 75,000. And then, yeah, we're going to continue it on at 75,000 there. And because we make that adjustment now, we'll be able to be cash positive. It'll be tight, but we'll be cash positive. So again, it's just super simple, simplified version of that prior model that I was showing you, but I'm happy to send that out to anybody that's interested. Okay, so that is, I have some other common questions. If there are specific questions to cover, I'd prefer to cover those instead, but I have also some other common questions that I get. I'd open it up to you guys to kind of touch on anything else that I may have missed or that you guys would like clarification on.
Okay, Hunter, while we're waiting for that to come in, I'm going to put a message in chat. I've had a few people ask about slides. And so if you'd like those, you can either respond via chat, or the first information I'm going to give you is Tara Chrisman's email address with instructions that if you want the free offered template, just send an email to Tara with the word template in the subject line, or you could also add slides in the subject line, and we'll send you a copy of the slides. And if, of course, if you'd like some additional information, you can coordinate that through Tara. So Tara's really good. You'll come to understand that the more you interface with her. Interesting part of the survey is, while we've had a few people respond that indeed they're offered opportunities to be able to get a discount on their payables by paying early, predominantly the participants are responding, they're seeing what we're seeing, and that is that most companies are experiencing delayed payments more often than they're seeing opportunities to get a discount for early payment.
Yeah, and on the flip side of that, you can, if you're having delayed payments, you can also offer a discount to get that cash in the door. So it's kind of, it's two different sides of the same story. Another way to, as opposed to pushing payments out, is to try to collect sooner, and it may be giving a discount. So that's another thing to consider in trying to increase the cash in.
Okay, perfect. Thank you. I've seen a few more responses come into the survey. They seem to be reinforcing that times are a little bit tighter now than maybe they have been in the past. Let's see, any last questions? I think we are they're finished. So check your chats if you'd like either the free template that Hunter offered, or a copy of the slides. There's also contact information there for Tara. I've had a few respond via chat that they'd like the slides, and we'll copy that information over and have Tara send those out. And then again, the next presentation will be always the last Monday of the month. And the next presentation coming up will be on Monday, the 28th of October, Managing Human Capital, Key Considerations with Recruiting, Retention, and HR Compliance. So thank you very much for joining. We wish you a wonderful and prosperous week, and we hope to see you next month. Thanks, Hunter.
Thanks, everyone.